SVB held $91 billion in Treasury bonds, and as rates rose, embedded unrealized losses reached $15 billion, enough to undermine confidence when depositors started to withdraw. This wasn't an outlier. Across the banking sector, hidden bond losses totaled $620 billion, a risk that built up because the debt layer of the system required low rates for stability. When inflation forced the Fed to hike, those cracks became visible. Demographics shaped the policy response. An aging population and pension funds dependent on steady returns left policymakers with little choice but to act quickly. The Federal Reserve moved to backstop deposits within days, aiming to prevent a wider credit crunch. But what most missed was how this intervention would channel liquidity into technology stocks first. In a world where workforce growth is flat or declining, productivity gains become essential, and investors know that AI companies are best positioned to deliver those gains. Crypto markets picked up on this shift before the official response. Bitcoin broke above $25,000 on March 17th, even as regional banks continued to fall. Stablecoin reserves expanded that week, signaling that institutional investors were positioning for easier monetary conditions. By the time the Fed expanded its balance sheet on March 22nd, crypto had already rallied more than 30%. These moves were not random. They reflected expectations that liquidity would return, and they anticipated where capital would flow next. AI and tech stocks became the immediate beneficiaries. Companies like Nvidia and Microsoft gained 25% and 18% respectively during the crisis period,